All right, let's go ahead and get started here. Hello, everyone. Welcome. My name is Laura Kendall, and I lead the marketing efforts here at InnoVint. For those of you that may not be familiar with InnoVint, we are a winery operating system. Our mission is to help wine businesses grow, make, and sell wine more efficiently through the use of our vineyard tracking, wine production, cost accounting, and compliance solutions. But that's not why we're here today. We're here and we're very excited to be putting on this series, the Winery Health webinar series, where over 3 events, we will be discussing with various winery leaders their strategies for improving winery financial, operational, and cultural health. And today we're focusing on financial health. So without further ado, let's get started. We do have a jam-packed agenda. So to start, I'll quickly go through some housekeeping items. Then I'd like to take a few minutes just to give everyone a sneak peek into the results of our State of Wine Business Health survey that we recently ran. Then I'll pass it over to our experts, Ashley, Peter, and Rick, and we'll jump into the panel discussion. And as a reminder, we will have time at the end for Q&A. So we'll go over how to do that right now. Housekeeping. Everyone on the call today is muted. But we can still make this interactive. The chat is open. Maybe everyone can share where they are dialing in from. It'd be awesome to see where we're representing, what regions. We will be recording today's session. So if you miss any key takeaways, rest assured we'll be sending out the full recording via email after the event today. If you do have any questions for our panelists, there's a Q&A section at the bottom. Feel free to use that functionality, and we'll get to as many of those as we can in the last 10 to 15 minutes. And then lastly, we do want to know what you think about today's session. You'll be prompted with the survey at the end, and we encourage you to fill it out so we know if this was helpful or what other type of content you'd like more of. That's it. So a bit about the survey. In May and June, we ran a survey, which many of you may have seen and participated in. Our goal was to assess the current state of wine business health across 3 vital dimensions that I've already mentioned, the financial, the operational, and the cultural. We did collect over 450 survey responses from winery professionals at wineries of all different sizes and in different regions. We are currently in the process of analyzing this data, but we did uncover some interesting insights that are relevant to the conversations we're having throughout these sessions. And so wanted to provide a little sneak peek to this group into the data before we dive into the panel discussion. So we asked winery professionals how they would rate their company's financial health. 54% believe that they are in excellent or good financial health, and 83% are of average financial health or greater. Now, given the sentiment in the media that wineries are struggling, this actually surprised us. And the data suggests that despite greater headwinds, wineries do have a good understanding of how to manage their financial landscape. Now, that's not to say that some aren't struggling financially. We do also see that 17% of wineries that responded rate themselves as having poor health financially. We also asked winery professionals to rate their winery's overall health. Do they have great, average, or poor overall health? And we compared those results to their financial health. Not so surprising, there's a clear connection between the two. Financial stability is fundamentally linked to the overall health of a winery. It's a critical, if not, the most critical factor when assessing overall company health. Next. We also asked respondents about how they'd rate their wineries in terms of their operational health and efficiency. Do they have great, average, or poor operations? And the link between these 2 data points is also quite apparent. Wineries that prioritize their financial stability are better positioned to achieve operational excellence. They can invest in things like advanced technologies and process improvements, things that are going to boost productivity and their overall operations. And on the other hand, wineries with poor financial health face some of the most significant operational challenges. Lastly, we looked at the impact of financial health on employee satisfaction and company culture. And again, there is a strong link. The financial health of a winery, as it improves employee satisfaction, tends to increase, and the same is true for company culture. So the benefits of good financial health go beyond just, profit margins, balance sheets. It enables better operational practices, employee satisfaction, and company culture. The data really is showing that financial health, operational health, and cultural health are all connected. They're all related to each other, which is why at InnoVint, we're so passionate about getting this data out there and hosting the series to have this discussion around practical approaches to running just an overall healthy wine business. We will be sharing this full report and our full takeaways soon, so stay tuned. But with that, I'd like to get into the meat of today's discussion, our panel. So I'm going to pass things over to Ashley Leonard, who is InnoVint's CEO and founder. After earning her V&E degree at UC Davis, Ashley has spent about a decade making wine and running wineries before she started InnoVint, which was just over 10 years ago. So no doubt she's a very credible moderator for today's discussion. Ashley, I'll pass it to you. Take it away.
Thank you, Laura. Hello, everyone. Thank you for joining. I'm very excited to host this first webinar of the series on winery financial health for sustainable growth. Like Laura illustrated, InnoVint is very invested in what it means for a winery to run a great business. While there's no one-stop shop or a single correct answer to that question, there are plenty of people to learn from who figured out what this means for their businesses. And we brought two of them here to you today. I want to tell you more about them and why we asked them to be part of this. So I'm going to introduce them and tell you more about their vast experience in winery leadership and winery finance. So first, I'd like you to meet Rick. Rick is not a ghost. Sorry for the background, Rick, there.
Yeah, I don't know what's going on with my video here, but sorry about that.
We'll work through it. No worries. Rick Lawson is the director of finance for Shafer Vineyards, a Napa Valley icon, of course, and has been leading finance there for the past 14 years. Rick has gone through the valuable process of selling Shafer to a Korean multinational corporation a few years ago, and he'll share a bit of what that experience has been like with you today. Prior to Shafer, Rick was in accounting for M.A. Silva, a major cork supplier I'm sure many of you are familiar with. And before that, worked in finance for other industries, following his degree in business administration and accounting from Cal Poly, San Luis Obispo. I got to know Rick a few years ago, and I invited him to be part of this discussion because upon meeting him, I immediately respected something about him. He embraced change. This is something that I've seen be a challenge to others in this industry, particularly those in long tenured roles, but not Rick. He's always been pro continuous improvement, pro technology, pro best in class solutioning, which is really indicative of the culture and the mindset that he's had as a financial leader. So thank you, Rick, for being a part of this conversation and sharing your experience with your peers today.
Thank you. I'll try to fix this video.
That's fine. I'm also so pleased to have Peter Willmert here with us today. Peter is the CEO of Hudson Napa Valley and oversees the winery, the wine brand, and the vineyards, and is one of the largest properties in Napa at 2,000 acres. He also oversees other Hudson-owned businesses that he'll share more about momentarily. Peter is a vastly experienced business leader in our industry, growing large wine brands, boutique brands, both domestic wineries and wineries under international ownership over the last 2 decades of his tenure in wine. Before taking the leadership opportunity with Hudson 4 years ago, he was the vice president of LVMH's portfolio of wines estates North America for 3 years under that French leadership. Prior to that, Peter was the general manager and partner for Redcar for 6 years. Redcar was one of the first brands I personally heard of that really put West Sonoma Coast wine on the map, and he led that company through that wave of growth. Prior to that, Peter worked for Treasury and specifically Behringer in marketing and brand management, following his MBA from Kellogg School of Business at Northwestern. And there's more. I learned last week that he was in politics before that and was a spokesperson for a presidential campaign. So he's clearly multifaceted. I've only known Peter since his time at Hudson, but I will say I've been consistently impressed with his leadership and the caliber and quality of the people that he employs. So he's clearly been responsible for building great businesses over the years. So thank you, Peter, so much for being a part of this panel and sharing your insights as well.
Thank you, Ashley. Delighted to be here.
All right. With that, you've met all three of us. Let's dive into the discussion. So the first question that I sort of commented on up front is that there's no real right way, like only way to answer this question. All winery leaders have a different answer to what it means to be financially healthy. So let's start with Rick. Why don't you share with us, Rick, what it means to you to run a financially healthy winery?
Well, I think for me, the real key is cash flow, positive cash flow. There's always competing goals, whether you want to grow your sales, you want to, invest in new plant and equipment, things like that. But the bottom line is, if you're not generating a positive cash flow, you're not going to be around very long unless you have some corporate sponsor that has very deep pockets. But so I'm always looking at the cash position, the company, trying to forecast ahead to big outlays that are in the near future, and just try to manage pretty much the cash flow.
Sure.
So I'll jump in as well. So I think that's a great answer. I think when I think about a financially healthy wine business, the first thing to really understand for yourself is what's the proposition of the business. There's no such thing really, as we all know, as a wine business. There are wine businesses. They're very, very different from each other. If you are a small winery in the Loire, your business looks very little like a large multinational corporation, which looks very little like a Pinot Noir business in the Willamette Valley than a Cabernet business in Napa. So what is your proposition? Kind of what does that mean? So what are you making? What are your price points? What are your channels? Because that's going to really kind of dig into your metrics. And then at what stage are you in to the project? I mean, if you're starting up your project, financially healthy will probably mean that you are putting a lot of cash into the business, right? And as everybody who's been in this business for very long knows, it takes a lot of money at the beginning, or it takes a lot of money to grow inventory, or it takes a lot of money to expand, or it takes a lot of money to further develop markets, right? You may not be in a financial harvesting moment, right? So, but within that, you have to be able to look at, well, what is that time frame? Does my proposition in some time frame, in some business plan, actually start to pencil out? And I think that is actually surprisingly difficult for some wineries to get their arms around.
Yeah, that's a good point. And I have a follow-up question for both of you, just given you've been at Hudson and Shafer for many years now. Have you seen that goal evolve over the years in terms of, the first year, very few wineries are profitable, right? You have to work towards profitability. I won't ask you both to answer if you're profitable today, but how has the business evolved, for you, Rick, through the acquisition, the balance on both sides of that equation? What does that look like? Are you focused on different things there? And then for you, Peter, with Hudson, looking at the different business units of Hudson, the farm that you run, the market that you own, how does that all sort of play into financial health?
Well, when I started at Shafer, Shafer was already a mature business, so we didn't, I wasn't there to experience any of the startup issues, but we were always generating very strong cash flow. Growth was not a goal. We had kind of hit our sweet spot. We had strong distributors. We were selling about 85% of our wine through distributors, and making good profits and cash flows there. But since the sale of the company 3 years ago, 2.5 years ago, the goals have changed. So there's a lot more push on growth. And in order to grow, we've had to expand winery capabilities. And so there's a lot of capital expenditures. We've acquired a couple of vineyards, which, as you know, in Napa Valley, that's not cheap. And so the issue has been a lot more for me there, it's one thing to grow the top line, but can we continue this and still be able to pay all the bills? And it's about I think in one of the seminars you had earlier, maybe it was about 6 months ago, we were talking about how it becomes like a 3 to 5 year proposition. If you want to grow, you got to start spending money now, but you're not going to really see the benefit of that growth until 3 to 5 years out. So by the time you acquire more grapes or more land, buy more, buy bulk wine, and by the time you bottle it and sell it, it takes a while. So things can be really tight in the short run. And so that's big change that we've been through.
Yeah, I would say, at Hudson, we still farm for over 25 different winemakers and wineries across Napa and Sonoma mostly. And that's a business that is a pretty steady business. It's not a big growth business, and it's not a big contraction business, right? And so within that, you basically have to build the organizational structure that can support what you're going to have every year, because if you're growing premium grapes, you're doing a lot of acreage contracts. You have a lot of reasonably fixed levels of income that you're going to receive. You can't. You have to make sure that you've created something that's financially stable, and it's increasingly difficult, right? I think all of us who are in the wine world, who see the cost of all inputs rising, which we all know, the cost of regulation, the cost of labor, the cost of anything that you want to do is going up, probably well ahead of inflation over the last 5 years. So how do you still manage to do that? And if you're doing things at a very high level, where you're growing grapes for very reasonably expensive wines, which is mostly what Hudson does, you're not going to cut a lot of corners. You're not going to take a lot of cost decreases, right? So that's always the balance, I think, in the vineyard business. And in the wine business, it really just, as I said before, it depends on where you are. If you are trying to grow and become larger because you think in your business plan that at a certain level of sales and a certain level of volume, you're going to have a much more balanced business, well, it's going to take a lot of money to grow that inventory. I think one of the things we should talk a little bit about, probably, especially for smaller and medium-sized wineries, is how much visibility do you have as the business owner to your P&L, right? What are you using exactly to understand your P&L? Are you pretty comfortable understanding what your cost of goods structure really is, what your fixed costs are, and what your variable costs are, and how that might change depending on the moment that you are, the year you are in the winery, whether you're growing and spending money ahead of sales, or whether you are more or less in supply and demand balance, and you're not growing, and then you're trying to make sure that you're going to be able to be profitable. A lot of wineries have an awful lot of cash that flows out of their winery that they don't see on the standard income statement, because an awful lot of winery cash has flown out in all kinds of ways that are going to show up on the balance sheet. And I think one of the challenges that people have, depending on what kind of software they're using and how much sophistication they're bringing to their finance conversations, is really understanding why their net income and their cash flows might be so different.
Great. We're going to double click on a bunch of those. You mentioned trends and you mentioned metrics. We will dive into each of those. The trends one first. So Peter, you just mentioned some of the macro trends that are impacting the globe right now, not just the wine industry, but what are some of those trends, if you want to double down on some of those, or some other trends that are specifically impacting the wine industry's ability to grow and flourish? How have you had to adjust the last few years? And how do you see yourself adjusting, going forward?
Yeah, I mean, I think the two or three biggest kind of global impacts that have been sort of well reported, and we won't go deeply into those here. One is a really large global oversupply of grapes. Europe's been oversupplied for decades. Southern Hemisphere is probably well oversupplied. They're pulling vines out of a lot of those places, but even on the West Coast of the United States, in some lesser appellations, growers can't actually make a living, and they're going to be pulling all of those vines out. that global oversupply really creates obviously a lot of pressure on prices. And so if you can't charge a price where you can make a profit, you're not going to do very well. And that is kind of the core of the Rubik's Cube you solve in the wine business, right? Is how are you going to have a proposition that can command a price point that gets you to the gross margins that you need. Those trends are going to be with us, I think, for some time. I think that we're not going to see supply and demand go back into balance overnight. And we're going to, as a result, see a lot of pricing pressure from brands and wineries that have propositions that are not as strong as they need to be, or that are just simply oversupplied. You know, it's a vintage business. It's not like other consumer goods where you can run 3 shifts at the factory or one shift at the factory. Here you make a vintage, you put it into your inventory, it goes onto your balance sheet. And at some point you need to relieve that and sell it. And that's when you have that combined with the incredible diffusion across the business, where no one supplier really has a lot of power in the still wine category. You have a lot of individual decisions happening all at once. Those two trends of downward pricing pressure from some suppliers and oversupply impact what we're going to do. So what do you do about that then? So what's the so what of that? The so what of that is really making sure that you are able to dig in and understand within your own financial package exactly what's going on with what you have. What are your, you know, how fast is your inventory turning? How fast should it be turning depending on your proposition? I mean, if you're making rosé and selling it in distribution, that's one business model. If you're making long ageable Cabernet and selling it mostly direct, that's a different conversation. There's no one metric that works, but making sure that you know what your target is, what your goal is, and that you're on track for that. Right?
Yeah, I think for us too, is we're seeing in terms of sales growth, we're seeing it impacted by demographics changes. When you're selling, you know, wine at an ultra premium price, it sort of presupposes that your customer needs to be at a certain stage in life that they can afford the wine. And as those people, and that tends to be at the older end of the age category. And as those people kind of age off, it's for us, it's been a real challenge to capture the younger and newer wine drinker at really high price points. So you get to the point where it becomes harder and harder to grow the business, just because there's fewer and fewer customers that can afford the wine. So, and that I'm just talking about Shafer specifically, but I imagine that impacts a lot of wineries, because wine, you know, it's not the least expensive beverage that you can buy. And so demographics change, tastes change. The younger generation seems to be more interested maybe in craft beers or distilled spirits. But that's been a little bit of a challenge for us too.
You know, actually, one other trend that I touched on earlier that I think we should probably come back to is this idea for a lot of wineries, they see their costs rising higher than their pricing, right? Mm-hmm. You know, in this diffuse market where there are so many wine brands, your own ability to take price increases is probably the only thing that's going to save you in the very long run. But it can be something that's very hard to do in a market where there is some oversupply and you have a lot of suppliers that are dropping prices or discounting or doing other things like that, right? So one thing that wineries should really be keenly aware of is their profitability by channel, and they should really be able to kind of sort out, you know, at what sales channel or what's within the sales channel with. Very specifically, where are they making money? Where are they losing money? Where are they gaining margin? Where are they losing margin? And where are they able to make some adjustments? If you don't feel like you can take a large price increase in the next year because of the market condition, because you're facing a headwind and you're sensing some challenges, what can you do to double down on your channels that are more profitable? You know, what can you do to put a lot more emphasis on those? How should you think about your wholesale and export business, perhaps, and some of the ways that you're going to market there? Are there ways to minimize some of the less profitable ways of going into those markets or not? Or do you just really have a lot of inventory, you have to get rid of it, and you're going to just make a decision that your financial health is going to be a little less good in that situation, but you need to relieve your inventory. Having stranded inventory is a really, really bad financial situation too, is right. That some inventory is really library. If you make collectible wine, especially red collectible wine, but most old inventory is stranded, and there are very, very few good options for relieving that inventory, and that can lead to other unintended consequences with wine health.
Absolutely. I want to cycle that question back to Rick, because Rick at Shafer has an interesting and semi-unique business model in the fact that you're a semi-small producer distributing 85% of your inventory. You mentioned earlier about inventory management and the consumer trends that Shafer's sifting through. How has that impacted your business given that sales channel distribution?
Well, traditionally, when you see articles that in the business press that says, the wine industry is this or the wine industry is that, it really hasn't affected us. We're small enough and we have a high enough price point on our premium wine that it's really more of a niche market. But the last 6 months or so, maybe a year, we are seeing some of the industry's trends starting to affect us. And it has been a challenge for our sales folks to go out and find new markets, to work more closely with the distributors that we work with, and just to ensure that the wine is moving. But it has made a change. I remember when I started at Shafer talking with Doug Shafer, it was right after the 2008 recession. And he was saying that we were hardly impacted by the recession because, again, our customers really weren't affected by the recession, and they aren't typically affected by inflation, things like that. But it sort of seems like in the last, like I said, 6 months to a year, we are starting to see a little bit more pressure on sales. And so, like I said, it just for our sales team, they just have to be a little more creative and continue to find new customers, new markets.
That makes sense. Okay, let's move on to the next question in the essence of time, and let's talk about actual financial metrics that both of you keep your eyes on. What are those, and why do you use those to measure success?
Well, I can start with that. So, when I think on the cost side, one of the metrics that I'm always looking at are sort of my fixed versus my variable cost. And it can be very, very hard for a small or medium-sized winery to get their arms around what that is. And you kind of have to go in and assign what those fixed and variable costs are. But those are sort of where your decision points really are. If you have a lot of fixed costs, you're going to struggle to change a lot of those fixed costs. Maybe if some of them are changeable, maybe some of them can be, adjusted at the margins, but those aren't really your big opportunities. Your big opportunities are with your variable cost. And what the variable cost is netting what exactly. So if times are easy, when the market is great and everyone's selling a lot of wine and things are good, people tend to be much less scrutiny. They put much less scrutiny against this idea, and then they really put a lot more scrutiny on it when they have to go through a period of belt tightening. I think that's particularly important when you think about cost of goods, especially, right? So when you think about what's happening within the winery, there's a certain cost of operating your winery that is essentially fixed. And there's a lot of variable cost depending on how much wine you're going to make. I think one of the things we're seeing across the industry right now are quite a few wineries across the globe kind of taking a pause on big volumetric increases right now. So that's one of the reasons that there will, across the globe, there's going to be fruit that goes unsold across vineyards, especially in secondary and tertiary appellations. There's going to be some tough times for quite a few people in the business as a result. So that's one. So fixed versus variable. Two, kind of, my general gross margins, my blended gross margins, and my gross margins by channel. Super, super important to really understand what that is and what's happening to my cost of goods over time, right? And are there things that I can do about my cost of goods over time or not? And are my general gross margins kind of in line with the kind of business I have? If I'm mostly a wholesale and export business with a small direct business, I don't expect to have a 60 or 70% gross margin, right? Because I'm selling at basically at least a half price or something like that, FOB price. But if I am mostly direct, then I am really hoping that, for a winery of my size, that I'm about 65 or 70% direct in revenue, and that I'm hitting a gross margin that's quite similar to that.
Yeah, I would agree that gross margin is important. The thing is, sometimes it's really hard to kind of figure out what's going on there, because in any one year, your cost of goods sold reflects maybe 2 or 3 vintages of wine that you're selling. So then you're sort of looking at, well, what was going on 3 years ago? Why is the gross margin smaller? Well, the yields were down 3 years ago. It really didn't have anything to do with farming costs. It was just yields were down. And so we do look at that, but we also look at all of our production areas as if they were expense areas like sales and marketing and admin, just to make sure that they're on track. Labor costs, contract labor costs. We're farming most of the grapes that we harvest. We do the farming, and until we purchased a couple of vineyards this last couple of years, the number of acres has been pretty consistent, obviously. And so we can see trends in increased costs there that don't necessarily show up in this year's income statement, because those costs get inventoried. But so you have to kind of look at both. And again, it looks a little difficult. It's a little bit difficult just looking at gross margin because the multiple years. And also some of the trends that we've seen, I don't know if we want to talk about that right now, but some of the trends we have seen increases in labor costs, but man, the insurance premiums are probably 4 times what they were 4 or 5 years ago, 6 years ago before the fires. And just other things. Contract labor has gone up faster than what we're giving raises to our own people. And I feel like we pay our vineyard workers very well, but everything else, it seems to be growing faster. So, and eventually that's going to end up in cost of goods sold 2 or 3 years down the road. So you're always kind of looking at multiple years back and forward and the current year, just to try to balance things and just make sure everything's staying on track.
Yeah, I think, Rick, that's a really good point about the kind of fluctuation you can have in cost of goods, that it's out of your control. And I think there's a piece of that. And that kind of leads right into the financial metric of profitability. And every different winery is going to have a different measure that they're interested in. If you're a very big winery, you're probably interested in EBIT or EBITDA, I'm guessing, if you're big and you have a lot of free cash flow. If you're a smaller winery, you may be much more interested in your cash profit than your GAAP accounting profit or your EBITDA. And I think one of the important things for smaller, medium wineries to do is to make sure that all the stakeholders in the business kind of align around what the metrics are that they really care about. It's very, very hard for a winery to try to manage a target across multiple profit metrics across multiple years, right? And you're going to have years where some of those profit metrics look better or worse, really just based on what you said, Rick, which is your cost of goods was higher or lower because you had a tough vintage or you had a bigger harvest. So every winery is going to decide kind of what their profit metrics are. Some of smaller and medium-sized wineries really care about cash profit or net income. And their, EBITDA is nice to know. And other ones are very interested in what their EBITDAs are. But they might be in a period where they have positive EBITDA, but are not spitting off any free cash flow because they're, say, expanding or growing inventory or something like that.
Yeah, the challenges of being in this industry where it's very seasonal, multi-year are very real. And we're looking at this industry benchmarks table here, which hopefully is valuable to many of you. We put this together actually before this panel for another finance event last year or earlier this year. And this is just, again, general benchmarking, right? Like to Peter's point earlier, you have to understand what your proposition is as a business to really put yourself on this chart in a realistic way. So can both of you comment on how this lands with you, either where your business is or how you think about these metrics, what's most important to you, those types of things?
Rick, you wanna go first?
Sure, I'll go first. I think the one metric that doesn't mean much to me is EBITDA. I just don't think it's a very useful metric. But since the sale of the winery, because we're now part of a big international corporation, they use EBITDA for all kinds of stuff. So we do have to report EBITDA now, and I think it makes sense. I think if you have multiple businesses or product lines or whatever, you're trying to compare one to the other. Which one do we really invest in? But I don't think in terms of operating and helping us run the winery, EBITDA is very helpful at all. I think the other ones are, you're always looking at your profitability or margins, like we just talked about, operating profit margin. We don't look too much at the amount of inventory on hand, mainly because we tend to sell almost all of our wine every year. So, and our numbers would be probably in the poor category, because we age some of the wines even after bottling. We age them for had been aging them for up to 15 months before we even release it. So our inventory numbers maybe tend to be high, but we're not that concerned because we know that each vintage we're eventually, selling it out within the year. So, yeah. So those are my comments, especially with EBITDA. I maybe different organizations find that useful, but we don't really.
Yeah, I think so you asked how these land. These land really well for me and kind of how I look at our business, right? So I think we are looking for, if we can have an FOB gross margin at least 50%, and for a small winery, it has that business then makes sense, right? Because that's just your gross margin. That doesn't take into account your sales costs, your marketing costs, any of your regular expenses, right? So if you're not starting off with some profitability in that channel, which can cost quite a bit of money to really execute well, then you have to, it can really kind of question your business model pretty quickly, right? Your direct gross margin depends on the kind of business that you're in, but for a Napa business, I think for Napa businesses, we say we should be in the 70s, right? High 60s and 70s. If you're a business in a different part of the country, you may have a different answer to that question, because that might not actually be what you or any of your neighboring wineries can achieve. And then you really get into, well, what is your overall channel mix, and where is that profitability going to come from? Some of it is how much volume do you have versus how much profit do you have? So highly volumetric, big volume wineries often have much lower gross margins. Big publicly traded companies frequently have, FOB gross margins that are nowhere near 50%, right? And so on a lot of their SKUs, especially when you go through the sheer number of different deals that they have on those, the profitability can get pretty small. But if they're really, really large businesses, that doesn't mean that the business is bad, right? And so you really have to marry this with the type of business that you have.
Super valuable context there, Peter. Thank you. Would one of you, perhaps Peter, because you were just on the mic, define what EBITDA is? We have some folks on this call that are not necessarily from finance and have asked, like, what falls below the line of profit margin and then falls to EBITDA for a wine.
So it's your earnings before interest, tax, depreciation, and amortization. So it's trying to really get at it's trying to take away some of the things that eat up cash, I think, right? And give you a picture of sort of an equivalized picture that you could then also compare across industries of what your profitability is. I tend to agree with Rick that for small and medium-sized wineries, it's nice to know, but you may not be making very many actual business decisions based on your EBITDA. If you're trying to put your winery up for sale, your EBITDA is going to matter a lot to anybody that's going to look at your winery from outside. As Rick mentioned, Shafer was acquired, and EBITDA is quite a big deal for them, and they're in other businesses, and EBITDA is how they probably look at all their businesses. But small and medium-sized wineries, maybe looking much more at, hey, can I achieve an overall blended gross margin that's ever going to get me to cash profitability? That's probably door number one, right? And maybe it's not going to happen this year, because maybe this year I'm investing in capital expenses, or I'm growing inventory, which means I'm buying barrels and I have new grape contracts, and my gross margins have to look good, even though my cash is not going to be great. But if I do that over the course of, let's say, 5 years, and then I reach a point of some stasis, then the next 5 years can actually look really profitable, because I'm achieving a blended gross margin that can support all of my other operating costs and still, within the business model, put out cash.
Mhm. Yeah, I think going back to EBITDA, the thing that makes it kind of difficult for me is you're sort of mixing. I can see adding back depreciation and amortization, because you're kind of getting to more of a cash basis, but then interest and taxes, are actually cash. You're paying that interest every month to the bank, and so to back that out, it makes things look a lot. You could have huge debt payments, and everything looks really rosy because you're adding back in the interest payments to your profit margin. So it just doesn't work well for us. But I can see in other organizations it might.
Sure. Thank you. All right, let's move on to our third to last question here. Speaking of capital expenditures, that's a big deal for a wine business. One of those is technology. So let's talk a little bit about your thought process around technology investments, what your most important tooling or platforms are to help you run a healthy wine business, and then how you justify these investments to the business as well. Rick, do you want to start?
Sure. Yeah, we just recently went through a project to upgrade from a hosted version of Navision, Dynamics Nav, to the BC Cloud version. And really pleased with how inexpensive it is to go with cloud-based software as a service. I guess another way to talk about, to identify it, but it went really well. And it also allows us, there's so many people using that platform. There's a lot of add-ons that you can get, whether it's AP automation, reporting, things like that. So that's been really good for us. We've also have been able to tie that to our DTC software. We're using Commerce 7. And that makes things go a lot more smoothly. We're not keeping customer information or consumer information in the accounting system. It's in C7. And so that kind of cleans up our books. We're mainly the customer information we have in the accounting system. In BC Cloud is just the distributor customers. And then we're also looking forward to linking into InnoVint. Right now, we're using, obviously, InnoVint for our winemaking software, but because it's not connected to the accounting system, we're having to write a lot of journal entries to keep everything in sync, bulk wine reconciliations, things like that. But that is something we're going to be able to add on to in the near future. We're going to keep working on that, so that when the winemaker, moves wine, adds additives, whatever, those obviously move dollars at the same time and update inventory numbers. So we want to be able to have that come over automatically into the accounting system, so we can track everything there also. So, but yeah, it's having gone through a couple of different technology upgrades over the years, the cloud-based systems seem to be a lot more cost effective. You're paying monthly rather than spending tens of thousands of dollars to buy the software up front. It just seems to work. I think it's a better model for us.
Yeah, I don't have too much to add to that, because I agree with him. We're on a lot of similar platforms. I would say what InnoVint does for us, and it does for me, is it helps me really understand what I talked about before, which is my fixed and my variable costs. And it lets me kind of decide what are the sort of shared burdens that burden your cost of goods across everything, that for a small or medium-sized winery doesn't matter, that for a large winery probably matters a lot. Let me give you an example. So, when you think about making wine in a winery, you have a certain amount of cost of just running the winery, and every month that your wine is in the winery, it takes on overhead expense. So if I have a rosé that's only in there for a few months, the rosé looks very cheap to make, and it is actually cheap to make, but it's not cheap to make because it isn't absorbing cost. I have that cost whether my rosé is there absorbing it or not, right? So the fact that my 2-year in barrel wine is absorbing a lot more cost, but my fast turn wine is not absorbing cost is not actually what's interesting and actionable. What's interesting and actionable is how much labor and inputs went into that wine, so that I actually can understand what my variable cost is on that wine. And so I love that about this, because it helps me as a smaller or medium-sized winery make a better decision than just, there's a little discount factor that I might bracket around some of my cost of goods based on how these fixed costs get spread across inventory. If you're a really big winery, you care a lot more about that. If you're a publicly traded, you care a lot about that, because that all just flows through your GAAP accounting. It flows all the way down to your EBITs. It flows through your gross margins. Everything that you report matters. So of course you love your rosé if it has a great margin, because it didn't absorb any of your actual costs. But if you're smaller and you're thinking more on a cash basis, this kind of technology really helps you uncover that.
I've heard a lot about cost accounting from both of you and the financial systems that you've chosen, and having that flow up to kind of top line reporting. If you think about this whole conversation, even just the industry benchmarking slide that we just showed, all of those are dependent on accurate COGS. If you don't have accurate COGS, those are all out of whack. And whether you're public or private, your financials are unreliable. So at the end of the day, all of this is just this like waterfall effect where you have to have these key essential metrics in place, in line, and accurate, not peanut buttered, but accurate on a per SKU level, like Peter just said about rosé, right? It's important to understand the healthy margins you have there. That all ties into winery health, business health.
Yeah, no, absolutely. I think a lot of wineries surprisingly don't really understand what's underneath their cost of goods structure, right? And so they don't. What matters about your cost of goods are several things, but the most important thing is, one, can you do anything to adjust it? And if so, what would that be? And that's coming back to this idea of fixed and variable costs, right? Your variable costs are probably the things you can most control. Your fixed costs, you can look at them, you can decide which ones you can control or not. And then your pricing, right? And if you can't, as we talked about earlier, if you can't take price as a price increase, what can you do to impact profitable channels? And those are the things. You only know that, though, if you really kind of know what your overall cost of making a bottle of wine is. An average bottle of wine at my winery costs X. My rosé might look really inexpensive, and my red wine might look really expensive. And maybe that's sort of true, but maybe it's not entirely true. But if I know what my blended cost of goods is across everything that I'm doing, and I know what my revenues are, it sounds so simple, but it is really surprising how many wineries don't, how many winery leaders won't be able to just kind of tell you what those are off the top of their head. They won't know. And they won't really necessarily have a system that tells them right away either. You can't easily just pull this out of QuickBooks, which is what a lot of people are on.
Absolutely agree with that. Yep. All right, we have some great questions come in. Let's go to the final two questions. The first is, I think it'd be fascinating for all of us to hear what you both think is in store for Napa the next 5 to 10 years as ultra premium producers yourself. So Peter, do you want to take that one first?
Sure. I think Napa is fortunate in many ways in that it has done a great job long before I was here of kind of building a wonderful global reputation for really specific things, and it's known for really specific things. I think, though, some of what Rick talked about with evolving consumer tastes and preferences and drinking habits, combined with a proliferation of wineries that may not really have a very clear business model in the future, as well as wineries that don't have a clear succession plan in the future, we will see some real M&A activity continue in Napa. I think is going to be one of the headlines. So Shafer's certainly not the last vineyard that changed hands, There have been many since, and there will continue to be many more. I think that that's going to continue to happen. And I think that the businesses that are here are going to have to continue to really sharpen their proposition and how they do business, because the cost of operating here is going to continue to go to rise potentially faster than you can mitigate it with pricing or channel mix in terms of your revenues.
Thanks, Peter. Rick?
Yeah, I think I don't really track the all of Napa Valley that much. I don't really know exactly what's going on, but my sense is that it's pretty much every acre that's available has already been planted. That may or may not be the case, but it's getting pretty scarce. So if you want to grow and source more grapes from Napa, and that's the other thing about our industry, because of the labeling issues and stuff, you can't just buy grapes anywhere. If you want Napa grapes, they've got to be grown in Napa, obviously. There's going to be more and more consolidation, more and more bigger wineries buying smaller wineries, buying vineyards, and it's not cheap. I mean, it's up to like $500,000 or so per planted acre. So we're going to see a lot bigger players that are consolidating, purchasing smaller wineries. And I think the other thing that's kind of changing too is similar to what we went through. The first big, it wasn't the first generation, but maybe where the Napa wine boom started was in the early 70s. And so you have a lot of people like, the Shafers, they came out in the early 70s, and they maybe pass on to the next generation, but at some point there's a generation that doesn't want to be involved anymore. And so you'll see a lot of things moving from family-owned wineries to more corporations. And I think that's going to continue to happen over the next 5 to 10 years and beyond.
Absolutely. Thank you both. All right. And finally, what are 1 or 2 words of advice that you have for this group, or something you wish you knew 5 years ago that you can share?
Well, I knew this 5 years ago, but my staff at that time, it was myself and a part-time accountant. So it's a little bit different now, but I would say surround yourself with good people, because there's always more analysis to be done, more things to do. And if you have good people that you can trust, it really helps as you're making presentations to senior management, and they know your staff and they know that everybody is doing a good job, then they tend to trust the numbers that much more. So surround yourself with good people.
I echo that, Rick. And I guess one thing I would say, and I don't know if it was 5 years ago, but I think all of us that work in this know we work in a business that is so seemingly simple, right? We're making fermented grape juice, we're putting it into bottles, we're putting an ancient closure on it, we put a label on it, and people enjoy it with friends and around the dinner table. And at the same time, it's one of the singularly most complicated businesses you could ever possibly get yourself into. And the way you're going to succeed is if you can really drive to crystal clarity with your senior executive team and your ownership around where you're going and what it is that you're measuring, and then get really, really good at measuring it. And it's hard because those of us, especially in smaller and medium-sized, family-owned or LLC kind of style wineries, we don't have gigantic teams of admin and finance and help, right? So we need to get really, really clear and then understand how we're going to get the information for those metrics that we need to understand in order to succeed.
Well said, both of you. Thank you so much. I don't run a winery business, but I will agree with both of you that InnoVint success is based on having great people on your team that you trust, and also driving with a very clear vision forward, right? That you don't just own that, but you share that with the rest of your team, and everyone is following that same North Star. So thank you both so much. Hopefully this was valuable to everyone. We have some great questions in the Q&A, so I'm going to pivot to those now. I'm going to take a low-hanging fruit one first. Rick, someone asked, which accounting system did you say you use that's cloud-based? And I believe who is your integrator as well for your new ERP?
Yeah, the software, the customization for the wine industry was done by Western Computer, is 365 Wine Trade, and the Amacan Group is the consultants that we worked with, Jeremy Grant and his team there.
Thanks, Rick. William asked a question at the midway through our discussion that is valuable. He says, with a small vineyard and winery, what are some best practices or suggestions for developing a balance sheet with high visibility into the business? Specifically, can you talk about structuring the relationship between the vineyard and the winery on the balance sheet?
Well, I can take that, and I don't know about structuring it, but I think one of the ways that we look at this is we have a gap. We kind of have two versions of our accounting. We have a GAAP version, and then we have a cash version. And so when we do our budgeting, we go ahead and take balance sheet items that are going to cost money that year, and we put them into one form so that it spits out a net income at the bottom. That's before, that lands before you reverse things out to the balance sheet. That can help you on an annual basis. I think what doesn't help you then is when you think about vineyards, it's a little like building a winery. Vineyard development is extraordinarily expensive. And I think it's very hard to understand, even for people that do this for a living, what's the cost of developing an acre of vineyard land, right? What's the actual cost? Because it's so many years of development. It's across so many different P&Ls. It's across so many different little small invoices. So you have to be able to do both. And you have to be able to sort of step back and kind of do a side project around, well, what's the cost of developing it? If I have to replant, and if you're working on a vineyard, if it's going all the way to bare earth and fallowing and putting in rootstock and budding, or are you just going to sort of top work it and have something happen a lot faster? Those are two very different answers for what those are going to cost. And where you are and geographically, that'll be a big difference in what it'll cost as well. So I guess that's kind of the way we manage it here, having a big vineyard business and a wine business too, as well.
Mm-hmm. Yeah, I agree. I don't know if I have anything to add there.
Great. Thanks, Rick. Thanks, Peter. Next one on here is from Josh. Will InnoVint be available for accountants to use for their winery clients that aren't doing proper wine costing? Great question. We get this a lot. It's obviously advantageous for accounting professionals and controllers to use InnoVint or have access to InnoVint for proper COGS. Let's talk offline. Yes, we do have a happy path forward there if you have winery customers you'd like to use InnoVint for cost accounting. Let's see. Do you have any other recommendations for accounting software besides QuickBooks Online that mid-sized wineries are using? Ooh, that's a good question. Rick?
We use QuickBooks Online, so I'll let Rick see what he has to say.
Well, like I said earlier, we switched from, or it's really an upgrade from Microsoft Navision to BC Cloud, which is their cloud-based version. So, and when I said earlier, it was pretty easy transition. It wasn't very expensive, but that's partly because we were coming from Nav already. So the data didn't really need to be converted. So it might be a bigger deal coming from QuickBooks Online, but we've been really happy with BC Cloud so far. It's only been a couple of months, but we're looking forward again to some of the add-ons. We're using Cosmos for a reporting tool that's working really well. We're hoping to be able to add on Power BI for dashboards, things like that. And like I said, we're looking at automating AP with is it Continia, I think is the name of the software for the AP automation. We're going to try to look at that also.
Thanks, Rick. 1 minute left and 2 more questions. Let's see if we can get it in. Is there an API between InnoVint and QuickBooks Online? If not, are programmers or third party working on this solution? Great question. I will go on record confidently and say that if you're a small to mid-sized winery on QuickBooks Online, you do not need a direct integration with it and InnoVint. We have a lot of fractional CFOs, cost accountants that will also say the exact same thing. I've never met anyone that runs the books for a winery on QuickBooks that says you need a direct integration. So if you're just going in and capitalizing your expenses at the end of every month across your inventory, it's a couple journal entries, and we have a couple steps that we can train you on how to do that and reconcile it with QuickBooks. And it takes 10, 15, 20 minutes each month. So anonymous attendee, please reach out and we'll help you do that. Last question from Patrick. Can Peter outline more specifically variable costs that are controllable, both for small and large wineries?
Yeah, no, that's a great question. So, I guess I would just, and I know we're out of time, but the cost of operating your winery, let's just talk about the winery instead of the vineyard business. So the cost of operating the winery is some of those things I would consider to be fixed. You're going to have a winemaker, whether you make 10 barrels or 100 barrels. You might have an assistant winemaker as well. You're going to have a certain amount of cellar staff that might go up by 1 or 2 people or down 1 or 2 people, depending on volume, but that's reasonably fixed. You're going to have a cost of power and the cost of insurance and the cost of the actual winery and the cost of all of your CapEx and the cost of your water treatment system and your et cetera. Those are fixed. Then within variable, the wines you're going to make are your variable costs, right? And so you have and that's where you have all of the power to sort of decide what you're going to do once you understand what your costs versus your revenues are on each of those wines, right? So your variable costs have everything to do with your grape contracts or your grape sourcing or your yields, or your packaging choices, your winemaking practices on a wine by wine basis. And the kinds of inputs that you're buying, the kinds of barrels you're going to use, the amount of barrels you're going to use. These are all very variable, and you may decide that some of those are within scope to look at. You may decide that they're not. You have a very fixed way you make wine. You do it this way. This is what you're famous for. You make this variety. It's from this vineyard. And so maybe that you will decide those are reasonably fixed costs because you can't reasonably change them within your business model. But go ahead and message us offline if that doesn't really answer your question. I'd be happy to talk about it more.
Great. I'm going to turn things back over to Laura. Just want to say thank you, Peter and Rick.
Yeah, I'd like to echo that. I thank you so much for attending today's event, and a big thank you to our speakers. We will follow up via email to anyone who was online or those that registered and weren't able to attend, and provide a way for you to get in touch with folks. We'll share the slides and the content that we went through today. And we hope to see you at the next session, where we'll be talking about operational health in the winery. That will be happening on Monday, July 15th. Enjoy the rest of your afternoon and wherever you are calling in from.
Thank
Thank
you
you very much.
Thank you.